Hello investors and welcome to Motilal Wealth. I am Mahindra Rao and today in this video we will be discussing about Motilal Oswal Midcap Fund. We have seen many other midcap funds in our previous videos like Edelweiss Midcap Fund, Axis Midcap Fund, Mirai Asset Midcap Fund and Canara Robeco Midcap Fund. If you want to know more, you can go and watch out those videos as well. In this video, we are talking about Motilal Oswal Midcap Fund. So before understanding the midcap fund as a category, you have to understand what are midcap stocks. So midcap stocks are companies with moderate midcap value. They are businesses with 5,000 crores to 20,000 crores market cap. These are the companies which fall between this market capitalization. Now these are the companies which generally fall between large and small cap companies, and the benefit of investing in this company is that the profits are expected to increase over a period of time, and not only the profit increases, it increases its market share, its value and its productivity as well, which shows a uptrend in any mid-cap company. Now in this slide we have shown how the SEBI has regulated and divided the companies on the basis of market capitalization. If the company is in the top 100 companies on the basis of market capitalization, those companies are large cap companies. 101 to 250 companies are the mid cap companies, and 251 to 500 companies are the small cap companies, and these are on the basis of their market capitalization, and this keeps on changing. This is decided by SEBI. So this fund will particularly invest in companies which ranks from 101 to 250 companies. So now we have to understand why you should be investing in mid cap stock. Why not large cap and small cap? So in this particular slide, if you see, we have shown that what are small cap stocks, what are mid cap stocks and what are large cap stocks. So now talking about small cap, the small cap companies are generally in an ideation phase. These are the emerging companies with no track record and which provides a higher risk compared to mid cap. So these are very small company which are less than 5,000 crore market capitalization, which are still in a ideation phase and to bloom. Vis-a-vis, if we compare the same with the mid-cap companies, those companies are in an expansion phase. They have done with their ideation phase, they now are expanding their businesses, and here is where the wealth creation happens majorly. So they are into that wealth creation stage and has a very high growth potential with established track record. We will not find this track record in small cap companies, but in mid-sized company we will be able to find the track record of the company in much details. If we compare mid cap and large caps are in a mature phase. They are very stable and provide stable growth and stable pricing. They have a very established business model. They are like 40, 50, 60 years old company doing business, and they are present in multiple sectors. They are like a conglomerate. So these particular companies will have a lesser risk compared to mid caps, and the returns will be lesser than the mid cap companies because you are taking lesser risk and generating lesser returns compared to mid cap. So these are the companies which has a potential to become the leaders of tomorrow. They provide you the highest growth prospect. Hence mid cap companies are to be looked out for and to be invested in, and this should become a part of the portfolio. Now, when we talk about mid-cap companies, we have to understand what is the risk spectrum of all the equity funds, which will be showing in the next slide. What is the risk return scenario of investing in a mid-cap companies? So in this slide, if you see, the large cap has the lesser risk but provide lesser returns compared to any other category of equity fund. So if you take a higher risk and invest in a large cap and a mid-cap companies, you will get a better returns compared to large cap. Then there is a multi cap, then it is flexi cap, then it is focused, and then comes the mid cap category. So mid cap category has a higher risk and has a potential to generate higher returns. The more risk you take, the more returns you will be able to. If you are investing for more than 10 plus years, this fund category or this mid-cap category should be a part of your portfolio. Now let's talk about Motilal Oswal mid-cap fund. When we have understood what are mid-cap stocks, what is the market cap that they demand from the market, and why you should be investing in a mid-cap companies, and what is the risk return spectrum that they provide as a category of mid-caps. So now we have to dive in deep and understand how Motilal Oswal mutual fund have created their portfolio around mid-cap stocks. So before understanding Motilal Oswal mid-cap fund, we have to understand what is the investment process that they follow. So they have a very stringent investment process of QGLP. This is a very disciplined investment process. So they follow this very thoroughly and rigorously, and they have been doing it for the last 10 years. more than 10 years in fact. So quality, Q stands for quality. Quality is the minimum threshold they have set for the ROE and ROCE. So the first filter they will have in a place, if there are 500 companies, they will filter out all the companies which has a lesser ROE than 15%. So companies which are providing more than 15% will be a part of that investment process. And then comes the growth and the longevity. So ensuring longevity of growth by investing in sustainable themes identified by investment team collectively. So they will identify the companies which will provide growth for a longer period. Growth for a shorter period will not be a part of the portfolio, but the growth for a longer period has to be there so that it becomes a part of the portfolio. And then they will be invest, and then the price. They will not buy any stock at any price. They will apply the PE and PEG framework. What is the PE the company is demanding at that particular price, particular valuation, and then it is again expanded on the basis of the DCF, which is the discounted cash flow. What is the cash flow that the business is providing, and then they will imply the returns and the growth that the company will provide at that particular price. So this process of QGLP they have been following over a decade, and this has helped them to generate better returns for the investors for more than a decade now. Now when we talk about the investment process, it is also very important to understand the risk management framework. So risk management framework is also well defined, and they are following this for a longer period of time now. So what is the risk management framework that they have defined? So the first risk management framework is the stock weightage and stock sizing. They have the minimum and maximum exposure limits set, so they will not be overweight on a company or underweight on a company. Also they have a sector sizing. They will not be overweight on a particular sector or underweight on a particular sector. So there are benchmarks set so that they will not be buying more in a particular sector. Diversification strategy, they are not over diversified, but they are diversified in a well manner that they will be investing in not more than 35 stocks. So 35 stock is the upper limit, and they will invest not more than 35 stocks, like 40, 50 stocks, 60 stocks will not be a part of the portfolio. So they are not even under diversified. They are buying good companies in good numbers. So this is their diversification strategy. Also on time to time basis, they will be doing that profit booking and stop loss framework. So they have defined the framework for this. Whenever there is a profit booking which needs to be done from a particular stock, so they do not go overweight on a particular stock. So there is a profit taking framework in place. Also they have a stop loss framework in place, so that whenever the stock falls more than a certain limit, then it will not be a part of that portfolio. Stringent liquidity framework, they ensure there is a good amount of liquidity available in the portfolio, so that whenever there is a necessary action which needs to be done, or there is a redemption pressure which needs to be done, then it is fulfilled, and some cash is required to buy some good stocks at a better price valuation. Whenever the opportunity knocks the door, then they have that liquidity available to buy into that particular stock. So this is the risk management framework. They have defined it very well, and they have been using it for over a decade now. So this is a good rule based investing what they follow as a fund house. This is the process they follow for their portfolio management services and all their mutual fund schemes. So QGLP is the investment process framework, and this 5 pointers are their risk management framework. This helps them to create a very healthy portfolio, which ultimately helps to generate better returns over a period of time. Now let's understand fund features at a glance. The investment objective of the scheme is to achieve long-term capital appreciation by investing in quality mid-cap companies having long-term competitive advantage and potential for growth. The scheme is an open-ended scheme. It started in 24th February 2014. Mr. Niket Shah and Mr. Rakesh Shetty are the fund manager. The current standard deviation of the fund is 14.63 and the beta of the fund is 0.81. So they are taking lesser risk than the market. The market beta is 1 and fund beta is 0.81. So they are taking lesser risk than the market in this particular fund. And the fund AUM is 6,000 crores. They have 25 plus years of fund management experience in managing investors' wealth. This particular fund has a 9 plus year of performance track record of delivering 20% CAGR return since inception as of 31st October 2023. This fund follows a benchmark of Nifty 150 mid-cap TRI. Category is of course mid-cap. Ideal investment horizon is 5 plus years, but we'll suggest to invest for more than 10 years if you are investing in a mid-cap category, so that you make better returns out of the portfolio. And the risk profile is very high risk. We have understood in the risk return spectrum. So now let's understand what are the top 10 holdings of the fund. Where have they invested the major of their investors' money, and what is the top 10 holdings? Now if you see the top 10 holdings, the highest investment they have is in the persistent system, which is 10%, Jio it is 9%, Zomato it is 8%, Cholamandalam 8%, Coforge 6.5%, KPI it is 6%, Deepak Nitrate 5.98%, Balkrishna 5.9%, Prestige Estate 5.24%, and CG Power 4.18%. So these are their current top 10 holdings. Now once we have seen the top 10 holdings, let us understand where, in what sectors they have invested in. So we'll identify what are the top 5 sectors they have invested. So if we the top 5 sectors they have invested, first is the technology, where their weightage is 24%, financial it is almost 18%, automobile it is 11%, services it is 9.6%, and chemicals it is 8.71%. So these are the top 5 sectors they have invested in. So now let's understand what is the concentration analysis of the portfolio. If you see the concentration analysis, they are invested in 30 stocks. Top 10 stocks hold 70% of investors' money. So if you see top 10 stock, these 10 companies are currently holding 70% of the total AUM. So they are buying some good businesses and being overweight on them, or having a maximum exposure here. So they are following the risk management framework of not investing more than 10% in a particular stock. And if we see the top 5 stock, they hold 42% of the portfolio. And if we see the top 3 sectors in this slide, if you see the top 3 sectors, technology, financial, and automobile, these 3 sectors have a weightage of more than 50% in the portfolio. Portfolio price to book ratio is 4.75, and portfolio current PE ratio is 44.28. It is on a higher side currently because of the mid cap companies are demanding a higher valuation and have seen a good rally over a period of time. So the PE ratio is a bit expensive here. So now let's understand what is the performance the fund has given over a period of time and since inception. Since inception, Motilal Oswal Medcap Fund has delivered 20% returns CAGR. Last 1 year they have delivered 29%, last 5 years it is 23%, and since inception they have been able to deliver 20% returns. If someone would have done a 10,000 rupees SIP in this fund since inception for the last 9 years, he would have invested 11,80,000 with 118 number of SIP installments, and the current value would have been 31.5 lakh rupees. So the money have grown more than doubled in the last 10 years, right? So it is like 3x of the investment done. So a good returns have been generated over a period of time in this fund through SIP. If someone would have invested a lump sum of 1 lakh, that money would have grown to 6,97,000. So friends, this is all about Motilal Oswal Midcap Fund. Hope you have got all the information required to understand this fund. Do consult your financial advisor before investing and taking any investment decision. Thank you so much guys for listening, and signing off, Mahindra Rao. Until we meet again. Bye bye.